Welcome to this presentation about cryptocurrencies. I'm going to talk about what they are, how they work, and why would you use them. And first of all, let's look at the left bottom and see that a cryptocurrency is a store of value secured by encryption. It works using a peer-to-peer network and therefore does not depend on authority. And we can decrypt what that means a little bit, piece by piece. So store of value simply means that some people in this market want to have it, they want to buy it, other people want to sell it, and in the end it has a certain value, a certain value compared to all the other currencies out there or the other pieces of value like gold, etc. And but this one is secured by encryption, which means that the computer's software um, prohibits anyone from creating coins out of nowhere or for stealing them. There is a security around this, and I'm going to talk about that a lot later. But it is mathematically safe. Whether it's truly safe is another question, but again, we'll go into that later. Um, and then it works using a peer-to-peer network, and that is very exciting because so far everything you want to buy, every asset that you might want to have is dependent on, for instance, a government because it's dependent on a central bank, currency which is in the control of some government somewhere. It might so they can decide to print more or they can do whatever. And even if you go into buying stocks, there's an intermediary. There is companies in the middle if you want to buy something. So they have control over you. They have an authority over you. And of course, if a judge in some country that you maybe live in or where your money is at or your asset is at, if they determine that you should no longer have it, then they can take it from you, right? So there, it also always depends. Any asset you buy, it always depends on authority, and this is the first asset that does not depend on it because it's a peer-to-peer network. You don't need permission. You can have money or a cryptocurrency, and only if you have the private key can it be stolen from you. I'll talk about that more also a bit later. I on the right here have a list of currently the biggest cryptocurrencies based on market cap. So the price times the total amount of coins. And you can see Bitcoin is number one. There's also some other weird ones in this list that I want to mention. Tether, a USDC coin, Binance USD. And these are all exactly $1. You can see that right here. I mean, I've expressed it in euros, but this is $1. And their graphs also look a little weird because they always stay so close to the dollar that relatively to their previous value, they go up and down a lot. But in reality, this is basically a flat line. We're just zoomed in a lot because the fluctuations are very small. And these are called stable coins, and they are not real cryptocurrencies because the the ones that own this currency, the company, they will either create more coins or remove coins from the pool to make sure that they influence the price and that it exactly stays around $1. Right? So if suddenly a lot of people want to get more Tether, they will print more in order to avoid the market pricing this up above $1. And if suddenly a lot of people want to sell their Tether, they will burn um, those tokens in order, again, to make sure it always is $1. So those are stable coins. They are pegged, as they call pegged, to another value, right? In this case, the dollar, which is usually a much more stable currency than some of these other cryptocurrencies. Cryptocurrencies usually over time have been going up. Um, People buy them because they don't want to have a stable coin. They want to take an investment and speculate on the value in the future. But very often, once you want to get out of the market or wait a bit, you switch back to using a stable coin. Or you could just sell it for euros, but then you're going to have to use your bank again in a marketplace. And if you don't want that, stablecoins are a solution in the middle. So again, we'll talk about all of this. Now, I've already recorded this talk before, and now I'm basically doing a re-recording just to make sure that my screen size is appropriate. So I'm going to switch to what I've recorded before, just a second, and then we'll continue. Anyone can create their own wallet using a private key. We'll talk about private keys as well. So what allows you to control a wallet and doesn't allow anyone else to change anything on that wallet, right? That's very important. In fact, crypto is so secure that
unlike your bank account, theoretically with your bank account, if authority, the government decides I'm going to get your money, then obviously they can just call up the bank, and if they have a right order or some kind of judge, then your money's gone, or at least you're locked out of your account. And that cannot happen with cryptocurrencies. Cryptocurrencies, they are, again, everything's encrypted, and it is you with your private key. It gives you access, and no one else can possibly ever take that from you. Okay, so and lastly, I do want to mention that there's a bit of a confusion here, because we have layer 1, which we would call coins, and layer 2, which we call tokens. And what does it mean? Layer 1 is really the network. So Bitcoin, Ethereum, Cardano, those are examples of networks, and those networks, they have pool operators or miners, and they have these coins, right? The people who own the computers in the network, they get paid in coins. But then there's also tokens, which are a layer on top of the network, where people created their own currencies. An example of that would maybe be something like Tether, or let's see, these are all USD coin. I don't know about Terra, actually. Well, actually, the ones that I see here, Uniswap is a good one. Uniswap, I believe, is only on Ethereum. So Ethereum is number 2, and that's a layer 1. And a layer 2 would be Uniswap, which is on top of Ethereum, right? So, and it also has a value, and you can move money around, but it's just a layer above. And if Ethereum were, if everyone would turn off their computer running an Ethereum node, if that suddenly would no longer exist, then Uniswap would theoretically also no longer exist, because it's on top of it. Okay, so that's coin, and we generally call those tokens versus coins. Okay, so let's move on. Oh, I have their questions. I think maybe waiting could be good, because yeah, there's a lot more I'm going to discuss before. Anyway, let's just move on first. I'm going to discuss these 4 things about how cryptocurrencies work. I'm going to talk about miners and pool operators. I'm going to talk about how they install the software, and how that works, right? Because also, first of all, miners and pool operators, there's 2 different things, right? Why did I make the distinction between those 2? Why do you have 2 separate things? And that's because of the difference between proof of work and proof of stake, right? And that has to do with defending against a problem called the double spend problem, or other problems where people can try to spend money twice, which obviously is never, if I spend €5, I don't want to still use that €5 to, well, I want to, but other people don't want me to use that €5 to pay again for something else, right? They want consistency and security in their system. So you need some kind of proof to do this. And we call this the double spending problem. And first of all, you're going to have a network, and once I make a payment, that network, whoever you're buying from, is going to wait for confirmations. It's going to say, okay, only until at least a couple, or theoretically, preferably most, like 51% of all the computers running this chain, running this in this network, agree that I've paid those 5 Bitcoin or whatever it is, or 5 Cardano, and then only after most of them agree can we really be certain that you did it. Until then, it could be that you're still trying to spend that money elsewhere, right? And there is no consensus yet among the computers about whether you spent that money and on what you spent that money. Yeah, the transactions, there's a rule in cryptocurrencies in general where transactions with the most confirmations will become part of the blockchain, and competing transactions are discarded, right? So if there's a small disagreement, a couple of computers from some hacker in Russia say like, hey, this guy spent it on this, but other computers all said it spent on that, then it'll be that, right? So it's about the most wins. And we then assume as well that the hackers control the minority of the computers. And this is where that proof comes into play, right? The proof of stake or the proof of work. We want the hacker to not be able to control 51% of the network. And how do we do that? How do we secure it against it? So proof of stake, let's talk about proof of work first, because that's actually the original Bitcoin idea. So when Bitcoin started, 2009, it was kind of made as a response, as I believe, a response to the financial crisis. Trust in the banks was lowering, trust in the financial system was maybe lowering, and they thought, let's make a system that might work peer-to-peer without any authority in the middle. But this proof is required, so what do we do? Well, let's use energy and ASICs, which are application-specific integrated circuits. We can also use GPUs or other kind of hardware And this hardware, we're going to run this hardware and do some kind of, you can call it a puzzle. Theoretically, what it is generating SHA-256 hashes until it matches the target hash. Hashing is a one-directional operation. Sure, that's really what it's doing. But you can think about it. You have to invest energy and set up hardware in order to build the next block in the chain. And a hacker theoretically cannot do that as hard as the rest of the network. So for instance, just as an example, right, if you take the electricity cost for running Bitcoin right now, the average is already above the Netherlands, right? The entire Netherlands, all the energy we use in the country where I come from, um, is already less than Bitcoin right now on an average day, and on some days the maximum, we're reaching Canada right now. So theoretically, the hacker that's trying to take over your network will not have as much energy as Canada has. You know what I mean? So that's, or half Canada, I guess, and that's what protecting it. That's what's protecting the network from being corrupted. Yes, I know this is one of the criticisms against cryptocurrencies, which is why I'm for Cardano, because they switched it to proof of stake. Well, they didn't switch it, they started from proof of stake. Ethereum is actually switching from work to stake. And what proof of stake is very simple. It says, okay, instead of looking for electricity use and ASICs and GPUs, we're just going to say, okay, you don't need special hardware. We don't need to use a lot of your energy. In fact, it's almost no energy at all. But what you need to do in order to be allowed to make the next block, you need to own a certain amount of the currency that we have inside of the system, right? And that's why in this previous thing I called it a pool operator, because what we do, you have an operator that wants to build the next block in the chain, and he's asking everybody else to stake their money with them. And staking doesn't necessarily mean that you give your money away, although in Ethereum that is the case, kind of. But it kind of means that you're saying, I have a vote because I have a certain amount of money. I have a part of a vote in this system, and I'm giving that vote to you, and I'm getting paid for that. So you're giving your vote to the pool operator, and the pool operator collects all these votes, and then he has basically enough voting power to be the next one, to have a chance to be the next one to build the next block. And that's what pool operators do. So you have miners, pool operators, they do the same thing. They're building the chain and storing it. However, they do it in different ways depending on if you're using proof of stake or proof of work. So proof of stake is kind of the new kid on the block, requires very little energy. It does require that the currency is distributed and staked, because if like 50% of the coins belong to one dude, then he can basically make up any transaction he wants. So he can basically hack you really, really hard. So you need to make sure that that never happens, right? And in any serious blockchain, that would be almost impossible to do. Even if you buy up all the Cardano that is all the ADA that is on every marketplace, you would not reach even close to 50% of the total amount, because a lot of people are never selling. I mean, diamond hands. But okay, so this requires distributed currency. And also there is a bit of a thing with proof of stake right now, that it's harder to compress the chain. You can imagine that right now Ethereum, for instance, is like 2 terabytes to have the whole chain on your computer. And there are some nifty ways, some kind of algorithmic things we can do to kind of verify that the chain is correct without having the full 2 terabytes on it. And that would work for proof of work, but it doesn't work for proof of stake. Proof of stake is a little harder to compress, but that we're getting into some technical details now. I guess we should move on. So we handled this. We go to the next one. The network needs to allow people to create wallets that only they can transfer money from. This is the key. If you can't do this, you don't have a currency, right? You need people to control their wallet. Nobody should get into it. How do we do this? So I'm going to talk about public key encryption. I'm also going to talk a little bit, small amount, about the exact way that money is transferred in certain systems. Specifically, I'm looking at the difference between Ethereum and the rest, because I believe most of them use UTXO, which stands for unspent transaction output, but Ethereum uses an account system, which is one of the reasons why they're having so much difficulty in transitioning to a proof of stake. But okay, we'll talk about that. But so let's start off public key encryption, right? So let's imagine again, like this is Base. Like Base runs servers, and we have clients that connect. Like this is a classic normal IT system. But in a peer-to-peer system, we have some other problems. We have some additional issues. So the security that would normally work for server-based stuff might not necessarily work for peer-to-peer, even though what I'm talking about now, public key encryption, is also actually part of the communication between the server and the client. So it's actually used ubiquitously everywhere now. But before there was public key encryption, things work differently. So let's talk about the old school way first, and then I'll tell you about the upgrade basically. And the old school way, I think I was thinking of a great example, maybe like the Enigma machine, right? Because we're in Germany, so that's super relevant. The Enigma machine, Second World War, and we're trying to send secret messages between the Nazis, and we have a shared secret. Actually, it was a list of secrets, and those are, I think they were like written on a piece of paper or something. And then, of course, you make sure nobody ever gets those, and you share those. And then the messages you send can be encrypted with one of those words on the list, right? And then they can also be decrypted with one of those words on the list. So, and that's what you call a symmetric algorithm, because you can encrypt and decrypt the same value, that you're the same value. And so there's a secret, one secret, or multiple, and you can have a list, but they're shared between the two parties that want to talk, and that's it, right? And this is not really a nice way to do it, because you can imagine, first of all, if you lose your secret, obviously that would be bad, right? If the Allies would get the secret, that would be terrible, for the Nazis at least. And the how's called symmetric part of it is also a problem, because there are certain properties that asymmetric algorithms give that you don't get from symmetric algorithms. So let's talk about that. I'll put this little slide on the right, straight from Wikipedia, and I think it explains it pretty well. Asymmetric. So it means we're gonna have a key that's used for encryption, and another key that then is used for decryption. So you need two different things, right? And we can the name for those is, you have a private key and a public key. And in this example, we have a piece of text, hello Bob, and we're going to encrypt that with a private key, and Alice is going to do that, right? And then sends it to Bob, and now it's just like this little text, ciphertext. Like people don't know what this is. You need the code, the public key, to decrypt it back into hello Bob. And the beautiful thing about this is that the public key is public. It means that Alice gives this away for free, right? Alice doesn't care about other people knowing her public key, because it basically allows them to decrypt her messages. But here's the key, right? Like, we can do this in one way, but we can also do it in the other way, meaning that if she, oh god, now I have to say it correctly because it gets pretty complicated. If somebody encrypts something with Alice's public key, then only Alice can read it if she decrypts it with her private key. So it works the other way around too. And in WhatsApp or any kind of like secure encrypted communication, even your web browser, this is done, and it's done in both ways. So it's not just done. Bob basically encrypts with his private key, Alice with her private key, but they use each other's public key. And this way, you can answer two questions. You can say, first of all, you can know who encrypted the message, because if you can decrypt the message and read it, then clearly it must have come from Alice in this case. If Bob can read that message and he decrypted it with Alice's public key, it could have only been encrypted with Alice's private key. Oh, yeah, signing, not encrypting. Ah, fuck off. Same thing. So, but okay. So, who encrypted the message? That is an answer. You can answer that question. You know who encrypted the message, and you can also, from the other side, determine who is able to read the message. Right? If Alice encrypts something with Bob's public key, then only Bob can read it if he decrypts it with his private key or unsigns it, whatever you call it. So, I think it's decrypting, but. So it's basically a way, by having two keys instead of just one shared secret, you just have two and you use asymmetric algorithms, you can answer these questions and they can be secure, right? So you can start talking to each other and you know you're talking to each other, you know who's reading it, you know who encrypted it, and that's all you really want to know from these messages. Okay, so we need a key. We need a private key, right? That's how we start. If you have a private key, that's okay. Fair enough, Aaron. That's cool. But we need a private key. So we're going to have to create something that is unique and that only you know. and nobody else should know it, because if they do, then they can take all your money, right? So it's pretty critical that this thing is unique. And what we use nowadays in cryptocurrencies, for cryptocurrencies, is called a seed phrase, sometimes called a mnemonic phrase or recovery phrase, and it's basically 24 words out of 2048. And what that and that those can be turned into a private key. So it's, and I put here a little screenshot of one of the wallets where it shows you this, right? If I ever give these 24 words to somebody, then they would access the wallet that I created in this example, right? So that's the critical aspect here. And let's say, and I put a little text here for fun. Somebody wrote this somewhere on Stack Overflow, so I haven't actually checked it, but oops. But anyway, I thought it was pretty funny. And just to talk about the uniqueness, right? What if somebody starts guessing these 24 words, right? What is the chance? Because that's of course what you want to know. And at the end, it really sums it up, right? It says like, okay, if you have a network of quantum computers, they can check 1 quadrillion seeds per second, then still it would take like a tremendous amount of time, like 23, I don't know how many centuries before you can guess one, right? So it's literally impossible, basically, that somebody, no, actually, literally impossible that somebody would get these 24 words randomly. That's how unique it is, and it needs to be, because again, you're encrypting your stuff with this. This is important to you. Only this gives you access to your wallet. Also, there is something I want to clean up about wallets, or clear up about wallets, that some people don't know. Sometimes you hear about cold wallets, or you hear about like it. You get the feeling like a currency, a crypto coin or something, can be on a physical device and away from you, or that the coin is on there. What they really mean is that the private key is on there. That's really what it means, because your money basically is always just in the network, in the database, as a list of transactions, right? So you don't have any money anywhere. You just have your private key. That's the only thing that you have, that you really own. And then if you own it, you control the transactions that are on that wallet. Okay, so that's how it works. Finally, I do want to mention accounts versus unspent transaction output. Accounts, I say, work like a bank. You have a single balance, it gets updated, and logs are kept. I don't want to go into too much detail. I mean, this is a little difficult. It has more to do with programming. Later, I'm going to talk about how you can program with this stuff, actually. But UTXO is pretty interesting, because there you can, like, what if you go to an exchange and you buy a certain amount of Bitcoin or whatever, you get money. Like, let's see Alice here, she has 100 ADA. But what if she wants to sell or give some of it to Bob? In this case, she would put the complete amount that she got into the transaction, and the transaction basically says 90 goes back to you and 10 goes to Bob. And you can also combine things. You can say, okay, I put 90 here, 10 from Bob, 50 from Bob, and I put them all together, and then we split it like this, right? So you always have this idea that you have complete, what they call unspent transaction outputs. You put them together, and then you create new unspent transaction outputs. So you always end up with a list of unspent transaction outputs, and that's what you control within a specific wallet. Okay. And that's the system that most cryptocurrencies use, at least Bitcoin was the original one that used it. They've extended that model for Cardano, but they're basically using the similar thing, same system. Okay, next, markets. Oh, markets. So I'm not. First of all, I want to say I'm not an expert. I mean, I use the market. I bought some stuff. I mean, obviously, and I built some of these tools as well for fun. But hey, I'm not an expert. These are Japanese candlesticks I'm showing in the back. So it means like we're just tracking the price, right? And in this case, it's Bitcoin since the start. I just want to mention to everybody that since CoinGecko, this website, started measuring it, which was probably the price of one of the first exchanges before you, when you had liquidity pools for the first time. Anyway, it started at $50 and now it's at 50K, right? So that's a good profit margin, or good capital gains that you're looking at here over 8 years. But obviously, back in 2013, almost no one was thinking about Bitcoin. So it would have been a great risk if you started investing real money into that. But yeah, it would have multiplied quite a lot. And as you can see, if you invested, in this in 2021, right in January, I guess, you would have experienced this great dip, and you would have lost a lot if you sold. So the question is like, did you hold on to it until it climbed back up, right? So there's a high volatility, is what I'm saying, right? Like things go up and down very quickly in this market, and it's a risk. I mean, that's why I'm saying, like, don't trust me when it comes to financial advice. Value of a single token and coin is irrelevant. So I do want to mention this. Let's go back all the way to this one. So people, when they look at this, they might instinctually look at this price, right? And they think there's some kind of meaning behind it. I mean, they think that like, oh, the Dogecoin is 0.2 and Cardano is almost 2. So obviously Dogecoin can just get 2 as well, maybe. You can start to compare these prices, but that makes no sense whatsoever, because remember, the amount of coins that are minted, the amount of coins that are in the network is kind of an arbitrary number. They could have just as well done 10,000 less or 10,000 more. In fact, even when we say this number, we're talking about the price of one coin, but that's not theoretically really what's happening here, because each coin, like one Bitcoin, for instance, is 100 million Satoshis. One ADA, which is the Cardano main currency, is actually a million Loveless. So this is the cents, euro and euro cent. It's exactly like that, except we don't just have two decimals, we have a bunch more. So it is irrelevant what you call the price of one. It's really arbitrary. Could have just as well been a million more or less. So the thing that matters the most, I believe, is something like probably like circulation, liquidity, how many people are interested in trading. Like, so the trade volume might be interesting. Market cap could be interesting. Yeah, and in general, the relative price obviously is interesting too, right? If it dips 10% or rises 10%, it might tell you something about the value of a coin. But and of course the market cap, right? The price times the total amount of coins, that gives you a good indication. And that's why on all these websites, when you look at them, by default they're always sorted on market cap. And Bitcoin currently is number one, has always been number one. In fact, there is such a thing as Bitcoin dominance, where they think about like how dominant is Bitcoin over the rest of the entire industry, right? Because it's such a big player. You can see that money actually has been shifting more and more into Bitcoin in the last couple months. Before that, it was a bit more spread. Somehow people are believing heavily in Bitcoin again for a while, and so it shifts. And there's also many traders that just trade between these currencies. So yeah, you can also just look at the market in a total and see if that grows or not, and that can also be a great indicator of whether it's worth putting your money into cryptocurrencies. So cryptocurrencies are growing, it's getting more popular. You see the lines going up, number go up, and the Financial Action Task Force is very interested. They're interested because obviously this is now the Financial Action Task Force is a group, right? 200 countries, corporation, and they make law proposals, and then countries individually vote on whether they want those laws. But often it is agreed upon, because if you piss off the Financial Action Task Force, your country is going to be deemed high risk, and then suddenly you can't open bank accounts, your credit cards won't give you service. I mean, this is an important organization that you don't want to piss off. And they are starting to say that anyone who provides a service trading cryptocurrency, needs to become what they call a virtual asset service provider. And that is basically, as far as I could see, you have the same requirements as a bank, where you need to do money laundering preventing, you need to prevent terrorist financing, and you need to do know your customer, meaning you need to know the name, sometimes even the address and nationality of the people that you do business with. And this is kind of against the core principles of many of the original founders of cryptocurrency. The idea was like, we don't need any of this. And theoretically, you still don't. The only thing is that what could happen with you is that the Financial Action Task Force deems you a high risk. The banks will deem you a high risk. And then you have a problem, because eventually you need to go to a market to sell your coin if you want to get some kind of fiat money back, right? Because if you want to buy a house, yeah, it's going to be tough finding a guy who wants to sell you a house only with an ADA transaction. They usually want something else, and then you need to trade it. And all these traders will be part of the system that the Financial Action Task Force controls, and the banks. So if you did something not nice and they figure it out and your name is on the blacklist, then you basically have a real hard time selling your tokens. So this is why I called it in this slide the let's see, the Achilles heel of crypto, right? Like, oh, you can see it that way. Basically, we're not really freed from governments completely. It's just that we're living in a gray zone, kind of, and that zone is becoming less and less gray. It's becoming more and more serious, and people are taking cryptocurrencies more and more serious. So you can expect that basically, if you make your wallet and you buy something from a market, that market required you to already verify who you were, and then the tax audits from the country, so German tax audits, they will know which wallet you likely have, and they will demand taxes, capital gain taxes, for instance, when you sell. I don't know much about the exact numbers for how it works. I believe if you hold your money for a year, you don't have to pay taxes in Germany. That's the rule right now. But there are some exceptions for if you are in a stake pool and stuff like this. So it gets pretty complicated, and I don't like taxes. So I don't know. I will pay them, but it's hard to figure out exactly how much, and it's for every country. It's right now a little bit difficult to figure out. But I mean, the government will find out. So obviously, pay your taxes. Um, Lastly, I want to mention that there's some other stuff we can do with cryptocurrencies, right? We can make our own, right? Like other people you've seen, right? They've made their tokens, their own version of tokens, and they just made their own money. Now that money doesn't have to be valuable, but you can do it, right? You can make a certain amount of money. You can limit the amount people could have. You could then send it. You could have special rules because all of this is based on code, and this code itself is also put into the chain. And that's the interesting part. So what is a smart contract? Right, those are the things I'm talking about. If I'm talking about a special new currency, that is basically a smart contract describing how that currency works, and then you have a wallet that is controlled by that code, and that you can no longer change, right? Because I told you everything you put on the chain can no longer change. It's immutable. So once you put this smart contract out there, your money is there. It is live. Your version of money. So the Luke coin, so to speak. Let's imagine that I make a Luke coin, which requires a Luke smart contract, and then I can buy it. I can send it to people. Well, I can't really buy it until I put it on the market, obviously. And that's also what I wanted to mention. There are automated exchanges, right, which are also built out of a collection of smart contracts, which allow you to swap one thing for the other automatically, right? But of course, you need something like a liquidity pool, meaning you need other people to put their money into this, and they earn money from that, by the way. But and you buy it from them, and they are like the in between buffer that is being used as people trade these currencies. And this helps you because you don't have to then wait for somebody to, if you make an offer for somebody to buy it, because there's a liquidity pool, you can immediately buy whatever you want, or until the liquidity pool is empty, I guess, and then other people can buy the currency so that you can swap tokens, and that's why it's called Uniswap, right? And again, this is where those stable coins I talked about in the beginning are relevant because, so let's go to the beginning again for a second. If I first want to get my dollars and turn it into crypto dollars, then I would use either Tether or USD coin or Binance USD, because you can see the value of these coins is almost like exactly the dollar, right? 8666, and what is the other ones? 868 and 867, right? So they're all around the dollar, and these currencies keep it that way. They force it that way. These things are not real cryptocurrencies, by the way, because the reason they're able to control this price is because they can burn the tokens too. They can mint and burn them how they like, which is why I said they're not real cryptocurrencies, because they're not like stable coins. Those are these things. But if I'm going to a system like Uniswap, I want to have some of those because that's how I can enter very easily, because these are very stable, they don't change their value, and then I can later very quickly swap them for other values, right? So then you enter the volatile market that way. That often happens that way. There's also, I just want to mention some other things I've seen that have happened with blockchain technology. Something called decentralized autonomous organization. This is where basically I can say, okay, I'm a developer, for instance. I'm Luke. I'm a developer. I'm willing to work based on what people want, but I'm gonna first make my own Luke coin, and then anyone who has the most Lukecoin or has the most voting power to determine what I'm going to do, right? For instance. So this would be kind of a decentralized autonomous organization, because I'm working basically for an organization, but that organization is completely autonomous on its own. They have tokens and they have voting power based on the amount of tokens they have, and then they use that, right? And it could even be completely, because it's on a blockchain, it's decentralized. Anyone in the world could buy these things, right? Um, so there are some interesting things you can do here with voting and power, because you can work with smart contracts that can give people certain privileges, and it depends on how you set it up, right, in that organization. And you can create your own currency. And this is something you see a lot nowadays, that before you would have to have a company and you go public on the stock market and whatever, IPO and lots of money. But now you see kind of people with shitty projects, mostly programmers, they start initial coin offerings. Right, so they do a coin offering. They say, I just created the Luke coin. Hello, guys. Nobody knows what the value is of this coin, so I'm just going to start it at 1 cent, throw it into the market, and see what happens. And if you believe in my project and in the future of it, then go and buy it, and then the money goes up, number go up, we all get rich. Obviously, this is a scam, or could be a scam. I would not buy Luke coin if I was you. But anyway, it does happen, and also it's not necessarily a scam. There are projects that have an eco, that are serious, and that are just using it as an investment round. And you can also say that very often they combine it with that autonomous organization idea, where they say, hey, if you own my currency, then you get a vote in what we're going to do in this project. Of course, you then have to trust them. So obviously, I probably wouldn't. But I'm saying it's possible. People are playing around. They're pioneering the field of having your own currency that people cannot steal, and that is in a wallet that is secure, etc., etc. So you get all the advantages of a bank, but you're just a software developer who's writing this kind of shitty code, right? So it's very interesting what can happen here. And lastly, this is also a feature of the blockchain I want to mention, is highly secure long-term data storage. Because if you believe in cryptocurrencies, and we're moving on to a more serious global phenomenon, you can imagine that these blockchains are so important that they will never be removed completely from the world. They're like completely secure and long term. Nobody can hack them. Like if a hacker comes by and wants to, you have heard of ransomware, I assume, ransomware, right? It goes into your network, it steals your data, it encrypts everything, and then says if you have to pay this amount of money. They actually usually use cryptocurrency for that. But okay, you have to pay this amount of money, and then I'll give you the way to decrypt all your data. And by putting it into the blockchain, you can prevent this. Nobody can encrypt the blockchain. Like this stuff has been properly decentralized. It's not on one computer, and it's impossible to steal. So, and this is the first time that we have this kind of technology. Like that's very significant. Like a decentralized database you cannot take down, and that anybody can put any data in. Basically, if they have money, if they just pay for the gas fees to make the transfer, that is something unique, and that is something that the market doesn't know the value of right now. There's also some rumor that EU passports were going to have a blockchain non-fungible token on it. That could be pretty exciting. I don't know, but I don't know yet exactly how they're going to implement it. I mean, I've been hearing Cardano, I've been hearing IOTA, I've been hearing a bunch of blockchains that are interested, that are looking to get this win, but it's currently in a research phase. But it could be really exciting because, again, it's one of the safest ways to put information. And of course, you can encrypt this information. So it doesn't mean that just because you put it on blockchain, anybody can read it and it's completely public. It just means that the information is saved there. But now you could choose to first, encrypt it so that it's safe, and then you can decrypt it whenever you like. And all you have to keep safe then is your key. Okay. So why would you use cryptocurrencies? Now, in the background of this slide, I've put the United States money supply M2. I thought it was pretty exciting to see the line go up. So this is the amount of money that's being printed. And suddenly at 2020, COVID hits. And it's not just the US, by the way. I mean, Japan, Europe, everybody has been printing, right? To avoid some kind of slowdown, bam, line go up. What does this really mean that this line is suddenly so steep? I mean, it means that they're stealing money from you. Like if you're getting paid a certain salary, that same salary is not going to be as much next year. And it always was the case. That's always been the case. Actually, before 19 something, it wasn't the case. But ever since modern economics, they were like, inflation is great, so let's go print some more money. And then they've just done that times 10, right, in recent times. And a lot of people, including myself, really don't think this is a fair way to settle your debts and to boost the economy, because you're taxing anybody who owns euros. And that means that investors, rich people that don't own money, but they just own companies or buildings or whatever, they don't get taxed because they don't have their value expressed in euros. They don't have it on a bank account. They have it as something else. And that something else is automatically gonna get worth more because the euro is worth less, right? It's a trade. Or in this case, the dollar is worth less. I mean, dollar was hopeless anyhow, but a way to avoid this is to invest into something. And I also write here, invest into any other asset class, right? Any other, as long as it's not fiat, as long as it's not euros, dollars, or yen, or whatever it is, then you're cool. And for me, that ends up being interesting. Oh, I didn't know, Pascal. But anyway, they shouldn't, because we're inflating the stuff. Anyway, so I would like to, for instance, buy a house, but I'm too poor. So what do? I can't get a mortgage yet, or I don't want to yet. I can just get some crypto. Yes, it's high volatility, and I'm making an educated guess. I'm basically gambling, but at the same time, this gamble is going to be heavily in my favor because of inflation, right? If I keep in euro, I feel like I always lose, and at least with this, I might have a chance to actually win. So yeah, that's one of my reasons. Might not be too good of a one. Maybe I'm a bit too eager to take risk, but for some people, this is really wonderful. And also, again, I want you to imagine, why would you use cryptocurrencies? This is maybe not as good for you specifically as in Germany, because you trust your government. I mean, I trust the German government, right? They're not gonna do something plain illegal. I mean, I'm gonna assume this. I think it's a pretty reliable assumption. But sometimes you live in a country where you don't trust your government, or you live in Afghanistan and the Taliban is coming, and suddenly your traditional bank stops giving you any money, right? So these are real serious issues for people. And at that point, wouldn't it be better to have a global payment system that's peer-to-peer, so there's no one in the way? Now, of course, the problem is crypto safe? Yeah, it's very safe cryptographically, but if you lose that seed phrase, there's no one you can complain to. If you lose those 24 words, you just lost all your money, and you're done, right? Like, it's very sad. Like, so there's no one you can ask, there's no support crew, like Bitcoin doesn't have a helpline. So that's there. Is crypto safe? Yes, but it's not safe from your own stupidity, right? And your own negligence. So it's, in that way, it's not safe. If you're someone who's very clumsy and loses 24 words very easily, maybe not get into crypto, or maybe have someone else do it and insure it or something. I don't know. So it's a question: is crypto safe? But mathematically, yes. But reality, we don't know. It depends. And lastly, I do want to mention this because we have a bunch of software developers in the company. Of course, using blockchains and developing software on top of them could be valuable for your career, right? Like, I really believe that we're pioneering the world without banks, or at least the definition of a bank would change, right? Software engineers would make up a large part of a bank. They already do, but they would be even more, because the actual system itself would truly be completely based on software code. And you can also use it again to protect important data from being stolen. And like ECOs, you can raise investment money. So it could be a good way to start up a project if you don't mind getting your hands dirty with some weird marketing moves. I don't know. But these are all things you can start doing right now. And again, this is completely free. Nobody has to give you allowance to start using cryptocurrency, right? Like, this is a complete free system, internet money. And it's a new phenomenon, or at least new since 2009, relatively new, but actually it's old enough now, I think, that it has proven itself to be more resilient than people initially thought. Let's put it that way. And I want to end it here. I want to open up for questions if there are any. 50 minutes, pretty solid. What did you guys think?